Are you a retiree who has no clue as to the tax breaks that are available to you? Are you left in the dark about tax breaks that you could potentially be using? Do you want to start learning some of the tax breaks that really have been potentially missing you as a retiree? Hi there, my name is Kenner French. I'm with Vast Solutions Group, the nation's premier tax and financial engineering firm for small business owners. We deal with entrepreneurs and retirees all over the country who are in dire need of help, risk mitigation, tax mitigation, and retirement assistance. Sadly, all too often, people come to us after the situation has truly gotten out of hand. They've been paying too much in taxes. Well, in any event, we're here to help now, and it's as good a time as ever. That's what I would say. Now, did you realize the federal government offers a number of major tax breaks for older Americans? Some of these perks deserve more publicity than they receive, sadly. At age 65, the IRS gives you a larger deduction. For 2020, standard deductions look as the following. For taxpayers 65 and older, single filer, or married filing separately, $14,000. Head of household, $20,000. Married filing jointly, $26,100 when one spouse is 65 or older, or $27,400 when both spouses are 65 or older. The standard deduction for younger taxpayers range from $1,600 to $2,600 less. There are two situations where your standard deduction may be limited at age 65 or disappear entirely, by the way. One is when another taxpayer claims you as an independent. The other is when you're married and filing separately and your spouse itemizes deductions. Now, you may be able to write off some medical care costs, by the way. The IRS will let you deduct qualifying medical expenses once they exceed 7.5% of your adjusted gross, AGI. The list of eligible expenses is very long, beyond out-of-pocket costs paid to doctors and other healthcare professionals. It also includes things like insurance premiums for extended care coverage, travel costs linked to medical appointments, and payments for durable medical equipment such as dentures and hearing aids. Now, are you thinking about selling your home? Many retirees consider this. If you've lived in your current residence for at least 2 of the 5 years preceding a sale, as a matter of fact, you can exclude as much as $250,000 in gains from federal taxation. A married couple can shield up to $500,000. These limits, established in 1997, have never been indexed to inflation, by the way. This exclusion is allowed only once every 3 years. Now, low-income seniors may qualify for the credit for the elderly or disabled. This incentive is intended for people 65 and older, can be as large as $7,500 based on your filing status. You must have very low AGI and non-taxable income to claim it, though. It is basically designed for those living wholly or mostly on Social Security and their benefits. Affluent IRA owners may want to take a charitable gift IRA. Generally, once you reach 72, you must begin taking RMDs, or required minimum distributions, from a traditional IRA. You may not be looking forward to these annual withdrawals, especially if you're pretty well off. You have another option, though. You can make a qualified charitable distribution, or QCD, using those traditional IRA assets. You can donate up to $100,000 of traditional IRA assets to a qualified charity in a single year this way, and the amount donated counts towards your required withdrawal. The amount of the QCD is excluded from your gross income for the year of the total donation. Eligibility to a QCD still begins at age 70 and a half, even though the Setting Every Community Up for Retirement Enhancement Secure Act raised the starting IRA distribution to 72 and a half. It must be mentioned now that withdrawals from traditional IRAs are taxed as ordinary income tax, and if taken before 59 and a half, may be subject to 10.5% federal income tax penalty. Of course, some states also give seniors tax breaks. For example, the following 11 states do not tax federal, state, or local pension income: Alabama, Hawaii, Illinois, Kansas, Louisiana, Massachusetts, Michigan, Mississippi, Missouri, New York, and Pennsylvania. 28 states, by the way, and District of Columbia refrain from taxing Social Security. Unfortunately, your Social Security benefits could be partly or fully taxable. They could be taxed at both federal and state levels, depending on how much you earn and where you happen to live. Whether you feel this is reasonable or not, you may have the potential to claim some of the tax breaks mentioned above as you pursue the goal of tax efficiency. Now, some of these things we've discussed, pretty complex. If you're interested in contacting us, we'd love it if you did. Give us a call at 888-808-8278 or check us out on the web at www.vastsolutionsgroup.com. Now for me, once again, Kenner French, it's indeed been an honor to spend this time with you. We'd be happy to help you. We understand your plight. Thanks for taking the time once again.